In the world of investing, timing is everything.
I think the trigger will surprise people. I think what will happen is that sellers would become exhausted.
And today, we're diving deep into the insights of one of the most respected voices in the industry, Rick Rule. What if I told you that the next big move in gold stocks isn't just a possibility?
I think that's what's going to happen. The sellers will become exhausted, and the bids won't get filled. When the momentum gets established in the gold stocks,
But an inevitable seismic shift waiting to happen? Get ready for a journey into the heart of the gold market, where fortunes are made and lost in the blink of an eye. Strap in, because you're about to discover why timing is everything in the investing world. So, don't go anywhere and keep watching till the end.
I am surprised. I had anticipated that the increase in interest rates that we've seen would have had a harder effect on the economy. I would have expected that housing starts to be slower. I would have expected durable goods sales to be lower. I am pleasantly surprised by the strength in the U.S. economy. It is true that some of that strength is focused, as an example, in the equities markets. The great big tech stocks, the world dominators, seem to be the ones that are catching most of the bids. But I'm also surprised by wage strength. I'm surprised by the employment statistics. I'm cognizant of the fact that many Americans are suffering, that the wages that people are being paid do not necessarily compensate them well for the increase in the prices of goods and services that they consume. So I'm not suggesting that the economic strength that I see in the United States in particular has benefited everyone. But I am still surprised by the strength in the U.S. economy after those interest rate increases. Well, there's a lot of cash in the system, first of all. People have been afraid for a long time about the possibility of recession. Were we to have a recession with relatively high interest rates, there is a chance that you could have a liquidity squeeze, like 2008. People are nervous about that. The consequence of them being nervous is that there's $6 trillion cash in money market funds. And some of that cash now is finding its way back into the market. Your listeners need to be aware of the fact that the equity market strength is very concentrated strength. If you look at the S&P 500, which has done well, there are something like 10 stocks beyond the Magnificent Seven that have driven that market. So the market breadth, from the equity market breadth, is lousy. And the bond market the long bond market is still lousy. It's important to note that a lot of the strength is concentrated. And people do need to be aware of that. Certainly, 30% of the American population is going to be disappointed, no matter who wins. Personally, I need to say I'm disgusted that the choice that's in front of us is the choice that's in front of us. So I will be disappointed no matter who wins. I think, in more direct answer to your question, that whoever wins, there will not be a major change in economic and fiscal policy. Neither Mr. Trump nor Mr. Biden are world famous for attempting to save taxpayers' money. I think in particular that there's pressure on the Fed from the Democrats to pursue a much more accommodative monetary policy because they want to get reelected. Unfortunately, I expect monetary policy and fiscal policy to be very loose no matter who wins. I think that will probably give us artificial stimulus in 2024 and 2025. But at some point in time, Charlotte, we need to pay the pipe. We need to address the endemic debt and deficit in American society. I don't know when that happens. I don't know who happens. I know it has to happen, and I know it's going to be distinctly unpleasant when it does. As great a disconnect between the gold price and the gold stocks in my career since the early part of the 70s. I have also not seen as much investor hostility to gold stocks since 1970. Nor have I seen gold stocks at these valuation levels relative to book or relative to free cash flow. So the industry's suggestion that the market for gold stocks is at record lows is accurate. Now, I would argue, unfortunately, that the mining industry deserves that. The investors' expectation have been set by 50 years of poor corporate performance in the gold business. The gold industry needs to own the fact that in the decade 2000 to 2010, when the gold price went up sevenfold, free cash flow per share in the Philadelphia Gold and Silver Index fell. It took real talent to generate declining free cash flow in the face of the sevenfold increase in your price. And the juniors actually are worse. What investors need to understand is that although I think if you buy the sector, you go broke, if you buy good individual companies, you get rich. There are a few performers, both among the majors and among the juniors, that deliver so much value and so much performance that they add legitimacy to the whole sector. And I think it's that dichotomy people need to come to understand. I think, too, if you're going to participate in the sector, we learned, you and I, as an example, that you participate in uranium when nobody wants to be there. And the fact that nobody wants to be in gold is its greatest attribute. I'm understanding this is anecdotal, Charlotte. I'm not a social scientist. I do maintain a database of 80,000 investors. And what I notice is that the younger investors, the non-U.S. investors, and interestingly, the younger female investors, have no inherent hostility to gold because they haven't experienced the industry. It's the gold bugs. It's the people that have 30 or 40 years of experience in gold that are feeling hostile towards it. And this is something that just come to my attention looking at my own database recently. The younger investors who I talk to, which are by now most of the additions to the database in the last 5 years, are absolutely attracted to the gold thesis. They are absolutely open to participating in gold stocks. It's the people who have large inventories of gold stocks, many of which are junk, that feel hostility. Some of the paradigms need to change. For 50 years, people have invested in gold stocks because they thought the gold price was going to go up. They've looked for leverage to gold. The stocks that have the most leverage to gold are the companies with the higher costs, because as the gold price increases, their margin increases faster. So the gold investors have come to favor, ironically, investing in the worst companies. The new investors have a very different outlook. They are looking for good companies, irrespective of the commodity. So it's strange that the investors who have the least experience in the industry are at once the most favorably inclined and the most rational. This is the building block, the first building block of a bull market. Intelligent application of capital in a bad market is always, you'll remember the uranium business in 2022. The intelligent application of capital in a bad market is always square one for building a bull market. I feel over the 5-year time frame, very attractive. Not to the gold mining sector, which I think is a disaster, but to the high-quality companies, some of the high-quality companies that grab it today. I think the trigger will surprise people. I think what will happen is that sellers would become exhausted. I think that's what's going to happen. The sellers will become exhausted, and the bids won't get filled. When the momentum gets established in the gold stocks, what I think that you'll see, likely, and I don't want to give your BB too much hope, but I think it'll gap up. That's what's happened in past markets. When you exhaust the sellers, it gaps up. Here's an interesting statistic for you, Charlotte. Maybe I've used it before. Precious metals and precious metals equities comprise less than 0.5% of the total savings and investment assets in the United States. Less than 0.5%. The 4-decade mean is 2%. If the market share of precious metals and precious metals-related assets returns to mean, demand for them increases fourfold. And that's what I think happens. Does it happen in 2 years, 3 years, 4 years? I don't know. I have no idea. What I do know is that a gold bull market, a gold equity bull market, is such a profound event that if you're 2 years early, like I was on uranium, it doesn't matter.
It is a pleasure to have you with us on this journey to learn about the dynamic world of investing. Having learned from Rick Rule, timing is truly crucial to navigating the markets. But remember, timing is more than a skill. It is an art. So, if you're hungry for more insider knowledge, hit that subscribe button and ring the notification bell. Don't miss future episodes where we will reveal hidden gems, uncover the latest trends, and guide you toward financial success. Till next time, may your investments soar and your instincts be sharp. Be sure to shine brightly, and we'll see you in the next video.